If you are investing in real estate, you need a clear way to analyze a deal before you buy it, or you may end up with a money pit. I'll show you the best method I've used with countless clients to help analyze cash flow, expenses, ROI through a simple pro forma tool I've built. Too many investors simply focus on rent minus the mortgage, and that's their evaluation of the property. But that's not really how it's done. If you miss key expenses or underestimate cash flow, you could be stuck with an underperforming asset. That's why I built this rental property pro forma calculator to help you analyze a deal before you actually commit to it, ensuring that you have the best investment possible. In this video, I'll walk you through the 4-step process to analyze a rental property correctly to help you maximize cash flow and minimize risk. Step 1, enter the basics: purchase price, loan terms, rent. Step number 2, you need to factor in the right expenses: taxes, insurance, maintenance, vacancy repairs, property management fees. Step number 3, understand your returns: cap rate, cash on cash ROI. And step number 4, run what if scenarios. What happens if rents drop, or what if expenses rise? With all that said, let's run a potential deal through the pro forma calculator to see how the numbers pencil out and to see whether it's a good investment or not. So we have a mock deal pulled up, and this is in Citrus Springs, Florida. I'm pretty familiar with this market, done a lot of deals here, a lot of business here for my investor clients. And the purchase price on this property is $264,500. So following the first step, we're going to enter the property details into the pro forma. I've already entered some of them. I put the address here. This is a single family residence. The home was built in 2025. The square footage is 1,580, and we can see that represented here. It's a 4-bed, 2-bath home. Purchase price is $264,500. And we're going to use the assumption that the down payment on this property too is at 30%, and this client is getting a 6.5% interest rate. So this rate is not a rate that you can get on the market per se. It's just an informational rate for educational purposes only as we're analyzing this deal. Projected rents in this market are around $1,895 per month, and I know that from all the investor clients I've helped purchase 4-bed, 2-baths in this area. Now, if we go to step 2, this is where we start looking at our expenses. And if we come back to this listing and we scroll down to the financing and financial and listing details, we can see that the annual property tax amount is $119 per year. And the assessed value is $8,560. So my assumption is that this property was built in 2025 and it's just assessed off the raw value of the land, which, yep, I was right. Home was built in 2025, so it's brand new. And the land value is what we're seeing down there, the 86 or 8560. So the true property tax value of this home isn't really being assessed right now. So that will be reassessed later this year, but off of my experience in this area, property tax is around $300 a month. And the monthly insurance amount too from my investor clients is around $60 a month on the properties I've helped them purchase. And another thing that investors really miss is they don't look at the property management fees to manage a property, especially if it's out of state. It's going to be hard for you to manage stuff out of state without a property manager. And a safe bet is around 8 to 10% per month, or 8 to 10% annually. And that amount, so we just enter it here, and then it's represented in this section down below. Vacancy and repairs. This is more or less a capital expenditure account. You're allocating 5% of the gross rents per month to go into a capital account where you can save up for any vacancies that may come, or any repairs that may come up on the property as well. Some assumptions I want to point out as well is we're assuming that year over year, there's going to be an annual rent increase of 3%, and that in the first 1 to 2 years, annual appreciation of the home is going to be around 3% as well. Years 3 through 5 is around 6% year over year. Obviously, that may be a little high. Some markets, that's about where it is, but we'll just assume 6% year over year for years 3 through 5. On a future sale of the home, closing costs are going to be around 6%. That includes your realtor fees. That also includes your title closing costs, things like that. Now that we've entered in all this information and we're assuming that closing costs are around 3.3% on the purchase, we can really start dialing in what the returns look like on this property. So we can see that from all the information we've entered in, the cap rate on this property is at 5.85%. And then if we go over into this section here where we look at our ROI, we're going to see that in year 1, our cash on cash return on investment is going to be right around 1.85%. Right below that, we're going to see that cash on cash return on investment with the principal reduction in the loan balance is going to be around 4.17%. And then when you factor in that you can add in depreciation, like there's depreciation expense as well, that brings your return on investment up to 7.23%. And then when you add in the appreciation with all those other factors, it comes out to 11.73% return on investment, which is pretty strong. And if you're just looking at rent minus mortgage, you're not going to be seeing those numbers. You're really not going to be seeing the whole picture of what or how this property is going to perform. And that's the whole purpose of this calculator, is to really analyze the projected performance of this property. The section I haven't showed quite yet is down here in the bottom where it goes over annual appreciation, ROI. Year over year, it goes over what the principal reduction is in the loan amount. And this is just a scaling up of each year the principal balance is paid down, adding that up year over year. And then appreciation in year 1, we're just going to leave at 0. But in the event of sale, this is how much you would net out on the property. Assuming your closing cost, how much cost you were into it, all that stuff. You likely wouldn't sell this home until year 3. That's when you'd break even on selling this home. But let's circle back up to the section up here and let's run some what if scenarios. So let's say, what if the property doesn't rent out for $1,895 per month, and let's just put in a number of $1,700 a month. Let's see what it does to our rate of return. So our cap rate right now is 5.85. Cash on cash is 1.85. Let's see what it does at $1,700. So it brings our cap rate to 5.08, and our cash on cash ROI is actually negative. You would not be cash flowing on this deal. You'd be losing $51 a month, and that would be problematic. Obviously, you're not going to be spending $88,000 to then lose $51 a month. That's a terrible investment. But let's say we run the numbers and rents actually come in at $1,925 per month. That brings our cap rate to 5.96, cash on cash to 2.1, net monthly cash flow of $144 a month. Let's say our expenses were a little low. Let's bump it up to $350 per month for taxes. And let's say $90 a month for property insurance. And that bumps our cash flow down. Our monthly cash flow decreases, obviously, because the expenses have increased. So you can start to see the true value of utilizing a pro forma calculator to analyze your investment properties on the acquisition side before actually pulling the buying the property and then finding out down the road like, oh crap, we didn't factor in enough for property management fees or enough for property taxes or vacancy repairs, all these different factors that you should be looking at, and you're stuck with a bad investment until you can break even and sell the home or sell it for more than you bought it for. I hope this video was helpful for you. If you have a deal that you'd like to run by me, please submit it in the link below and I'd be more than happy to run that scenario for you. Until next time, cheers.